Every single day, the United States government pays $3.3 billion just in interest, not building infrastructure, not funding defense, just interest on borrowed money. By the time you finish watching this video, another $14 million will have been added to that tab. The debt isn't just growing, it's compounding at a rate that makes repayment mathematically impossible. We've crossed $39 trillion in national debt. Over the next 36 months, $9 trillion of that debt needs to be rolled over at interest rates triple what we were paying 3 years ago. This isn't political theater, this is arithmetic. And the numbers reveal exactly 3 paths forward, all of them painful. If you want to understand the math that determines your financial future, subscribe to The Econaut. We break down the economic mechanisms your government hopes you'll ignore. Understanding how America accumulated a debt load larger than the entire economy of every nation except China shows you why the acceleration is baked in. 45 years ago, in 1980, total federal debt sat below $1 trillion. The debt-to-GDP ratio was 35%, manageable by any historical standard. Then came 4 decades of systematic deficit spending by administrations from both parties. The Reagan 80s brought massive military expansion to counter the Soviet Union. Tax cuts reduced revenue while defense spending surged. Debt climbed from under $1 trillion to $2.8 trillion. The Clinton 90s saw brief stabilization. The budget actually balanced for a few years, but debt still grew to $5.7 trillion by 2000. The 2000s changed the pace entirely. Bush-era tax cuts, 2 simultaneous wars in Afghanistan and Iraq costing over $2 trillion, Medicare Part D adding trillions in unfunded obligations, and the 2008 financial crisis triggering $700 billion in direct bailouts plus several trillion more in Federal Reserve emergency programs. By 2008, debt had doubled to $10 trillion. The 2010s brought post-crisis stimulus, continued military operations, and additional tax cuts. Debt climbed from $10 trillion to $23 trillion by early 2020. Then COVID hit and all restraint evaporated. $5 trillion in emergency spending, unemployment extensions, PPP loans, direct stimulus checks, infrastructure programs, student debt relief attempts, expanded defense budgets. In just 6 years, debt exploded from $23 trillion to $39 trillion today. But here's the critical variable most analysis misses. It's not just the spending total, it's the interest rate environment. From 2008 through 2021, the Federal Reserve held rates near zero. The government could borrow trillions at virtually no cost. Average interest on federal debt sat around 2%, allowing debt to accumulate without triggering immediate pain. Then 2022 arrived. Inflation forced the Fed's hand. They raised rates from 0 to 5.5% in 18 months, the fastest hiking cycle in Federal Reserve history. Now all that debt borrowed at 2% is maturing and must be refinanced at 4.5% to 5%. The interest expense is about to detonate. $9 trillion in existing debt matures over the next 3 years and needs refinancing. Old average rate, 2%. New average rate, 4.5%. Old annual interest cost on that $9 trillion, $180 billion. New annual interest cost, $405 billion. That's an additional $225 billion per year in interest, just from refinancing debt we already owe. But the government isn't just refinancing. It's borrowing an additional $2 trillion annually to cover current deficits. 2024, $1.2 trillion in interest payments. 2027, $1.8 trillion estimated. 2030, $2.5 trillion projected if rates remain elevated. By 2030, the United States could be spending $2.5 trillion annually just servicing debt. That's 42% of projected federal tax revenue going purely to interest payments. Not defense, not Social Security, not Medicare, just interest to bondholders. Can't America just pay this down? The mathematics say no. To reduce debt, you need budget surpluses. Revenue must exceed spending. The United States hasn't run a meaningful surplus since 2001. That's 25 consecutive years of deficits. Current federal revenue, approximately $4.9 trillion. Raise taxes by $2.3 trillion. That's a 47% increase in federal revenue. Individual income taxes currently generate $2.4 trillion. You'd need to approximately double all income tax rates. Corporate taxes bring in $500 billion. You'd need to quintuple them. Even combining every possible tax increase, wealth taxes, VAT, carbon taxes, you couldn't close a $2.3 trillion gap without triggering economic collapse. Also politically impossible. Maybe we could grow our way out. If GDP expands faster than debt, the debt-to-GDP ratio improves, correct? Current GDP, approximately $29 trillion. Current debt to GDP, 134%. For the ratio to improve, GDP growth must exceed debt growth. US GDP grows roughly 2% to 3% annually in real terms. US debt is growing 7% to 10% annually. Debt is expanding 3 to 5 times faster than the economy. When the numerator grows at 8% but the denominator grows at 2%, the fraction gets worse every year. You cannot grow your way out of this. So if we can't cut spending, can't raise sufficient taxes, and can't grow fast enough, what remains? History shows only 3 paths for governments drowning in unpayable debt. Path 1. Default. Simply refuse to pay bondholders. Declare bankruptcy. Restructure obligations. Argentina did this repeatedly. Greece was forced into it. Russia in 1998. But for the United States, default is nuclear. The dollar serves as global reserve currency. US Treasuries function as the foundation of the international financial system. They're considered the safest asset on the planet. If America defaults, even partially, the dollar loses reserve status immediately. Global trade collapses because most international transactions are dollar-denominated. US borrowing costs spike to 15%, 20%, potentially higher. The government can't function. Federal employees don't get paid. Social security checks stop. The military shuts down. Financial markets crash globally. Your 401k evaporates. Your pension disappears. This is economic Armageddon. Default is theoretically possible, but practically unthinkable for a reserve currency issuer. Path 2. Austerity. Implement massive spending cuts and tax increases simultaneously. Slash Social Security by 30%. Cut Medicare by 40%. Eliminate most federal agencies. Raise income taxes by 50%. Reduce defense spending by 60%. This is what the IMF forced on Greece after 2008. But austerity triggers economic depression. When you simultaneously cut government spending and raise taxes, you drain demand from the economy. Unemployment surges. GDP contracts. Tax revenues fall further. You get a death spiral where austerity worsens the debt problem instead of solving it. And politically, it's suicide. No elected official voting for 30% Social Security cuts survives re-election. The population would revolt before accepting Greek-style austerity. So if default destroys the system and austerity is politically impossible, only one path remains. Path 3. Inflation. The Federal Reserve creates trillions of dollars digitally and uses them to purchase treasury bonds. This is called debt monetization, or when they want it to sound technical, quantitative easing. The Treasury needs to borrow $2 trillion, but can't find enough buyers at reasonable rates. The Federal Reserve announces, we'll purchase $2 trillion in Treasury bonds. The Fed creates $2 trillion digitally, they press a button, money appears. They use that newly created money to buy Treasury bonds from the government. The government receives $2 trillion in cash to spend. The debt gets paid with printed money. But when you create trillions from nothing, consequences follow. The money supply expands dramatically. More dollars, chasing the same quantity of goods and services. Prices rise. That's inflation. Your dollars lose purchasing power. This is already happening. The Fed's balance sheet, representing money they've printed, grew from $4 trillion in 2019 to $9 trillion at the peak in 2022. They printed $5 trillion in 3 years. The result? Inflation spiked to 9%, the highest in 40 years. Prices are now 20% higher than 2020 levels. Your paycheck buys 20% less. That's the inflation tax. And it's accelerating. The debt spiral has entered exponential phase. Year 1. Government runs a $2 trillion deficit. They borrow $2 trillion. Debt rises to $39 trillion. Interest payments climb to $1.2 trillion annually. Year 2. Government needs to pay that $1.2 trillion in interest. but they're already running deficits on everything else. So they borrow another $2 trillion plus the $1.2 trillion for interest. Total new borrowing, $3.2 trillion. Debt rises to $42.2 trillion. Interest payments climb to $1.4 trillion. Year 3. They need $1.4 trillion for interest plus funding for operations. Right now, we're adding $6 billion daily. In 3 years, we'll be adding $10 billion daily. In 5 years, $15 billion daily. The curve goes vertical. This destroys economic growth, and that's where it impacts real people. Economic expansion comes from investment and productivity. Businesses invest in factories, equipment, technology. Workers become more productive. Output increases. But when government borrows trillions, it crowds out private investment. Government sells $2 trillion in bonds to finance deficits. Who buys those bonds? Banks, pension funds, insurance companies, foreign governments. Where does that money come from? The pool of available capital. When government absorbs $2 trillion in capital to fund consumption, that's $2 trillion unavailable to businesses. A startup needing $10 million to build a factory can't secure a loan because the bank bought treasury bonds instead. An entrepreneur wanting to expand can't access capital. Real economy investment gets starved. This is crowding out. Government borrowing literally crowds out productive private investment. It worsens as rates rise. When treasuries pay 5%, why would anyone lend to a risky business at 7%? Just buy the risk-free government bond. All capital flows to government, away from productive enterprise. The result? Lower business investment, lower productivity growth, lower wage growth, lower GDP growth. The economy stagnates. We're watching this in real time. US productivity growth has declined for 20 years. Real wage growth has stagnated since 2000. GDP growth is stuck at 2% instead of the historical 3% to 4%. The debt is strangling growth, but the impact on individuals is even more direct. Here's exactly how $39 trillion destroys your standard of living. Impact 1. Higher taxes. Someone pays the interest on $39 trillion. That someone is you. Interest payments currently total $1.2 trillion annually, rising toward $2 trillion. That money comes from your taxes. By 2030, 42% of your federal income tax will go purely to interest on debt. Not programs benefiting you, not infrastructure, not defense. Just interest to bondholders, many of them foreign governments and wealthy investors. You're working to pay interest on debt accumulated before you were born. Impact 2. Reduced government services. As interest consumes more budget, less remains for everything else. Education funding gets slashed. Infrastructure crumbles. Veterans' benefits shrink. Research funding disappears. Social Security and Medicare become insolvent. You paid into these programs your entire working life, but when you retire, the money won't exist because it was spent on interest. Impact 3. Inflation destroys savings. The only viable path for unpayable debt is inflation. Government will print money to pay bondholders. Your dollars lose value. Your savings, built over decades, buy less and less. If you have $100,000 saved and inflation runs at 10% annually for 5 years, that $100,000 has the purchasing power of $59,000. You lost 41% without touching the account. Impact 4. Lower wages and fewer jobs. When government crowds out private investment, businesses can't expand, hire, or raise wages. Unemployment stays elevated. Workers compete for fewer positions. Wages stagnate or decline in real terms. You work harder for less money that buys less. Impact 5. Generational theft. The current generation is spending money and passing the bill to future generations. Your children and grandchildren will inherit an economy crushed by debt payments they had no role in creating. Their taxes will be higher, their services will be worse, their opportunities will be fewer. This is intergenerational theft on a scale unprecedented in human history. Based on current trajectories and historical patterns, here's the timeline. 2026 to 2027, the current phase. Debt grows from $39 trillion to $42 trillion. Interest payments rise from $1.2 trillion to $1.5 trillion. Markets remain relatively stable because the Fed is cutting rates slightly and there's hope for fiscal reform. Political dysfunction continues. No meaningful spending cuts or tax increases. The problem worsens, but gradually. 2027 to 2028, the acceleration phase. Debt crosses $45 trillion. Interest payments hit $1.8 trillion, consuming 32% of federal revenue. A major treasury auction receives weak demand. Yields spike to 6% or higher. The Fed is forced to restart quantitative easing to support the bond market. First clear signs of debt monetization. 2028 to 2030, the crisis phase. Debt approaches $50 trillion. Interest payments exceed $2 trillion annually, 38% of all tax revenue just for interest. The Fed is printing $3 trillion annually to buy treasury bonds. Inflation spikes back above 8% to 10%. Real wages decline sharply. Social Security and Medicare funding crises become acute. Political paralysis prevents solutions. Markets begin pricing serious default risk or currency crisis. 2030 to 2035, the restructuring phase. One of three outcomes occurs. Outcome 1, dollar loses reserve currency status. Oil trades in yuan or BRICS currency. International trade shifts away from dollars. The US can no longer print money to pay debts. Forced austerity or default follows. Outcome 2, hyperinflation scenario. Fed prints $5 trillion plus annually to monetize debt. Inflation reaches 15%, 20% potentially higher. Currency crisis. Capital flight. Economic chaos. Outcome 3, international debt restructuring. Some form of global conference where creditors, China, Japan, others, impose terms on US fiscal policy. Partial default on foreign-held debt. Loss of economic sovereignty. The exact form is uncertain, but the mathematics guarantees one of these outcomes within 10 years. Debt cannot continue growing at 8% to 10% annually when the economy grows at 2%. That gap must close, and when it closes, it will be violent. So what do you actually do? How do you protect yourself when your own government is destroying the currency? First, understand that inflation is the chosen path. Default destroys credibility. Austerity is politically impossible. They will inflate. Your defense strategy is positioning for inflation. Own hard assets that cannot be inflated away. Physical gold and silver. Real estate in strong markets. Commodities and commodity-producing equities. Bitcoin and scarce digital assets. If you understand the risks, international stocks and assets outside the dollar system. These assets maintain or increase value as currency devalues. Second, minimize exposure to dollar-denominated fixed income. Bonds, especially long-term bonds, get destroyed by inflation. Cash loses purchasing power. If you hold 10-year treasuries paying 4.5% and inflation runs at 8%, you're losing 3.5% annually in real terms. Guaranteed wealth destruction. Third, understand how inflation affects debt. Fixed-rate debt benefits borrowers during inflation. If you have a 30-year mortgage at 3% and inflation runs at 10%, you're repaying the loan with cheaper dollars. That's actually beneficial. But variable-rate debt or high-interest debt will destroy you. Eliminate credit cards and adjustable-rate mortgages immediately. Fourth, invest in skills and education that cannot be inflated away. During inflationary crises, survivors are those with valuable skills: medical, engineering, skilled trades, anything producing real value. You cannot inflate away a doctor's ability to heal or a plumber's ability to fix pipes. Fifth, build resilience and self-sufficiency. When currencies collapse and governments fail, supply chains break. Have stored food, water, essentials. Have backup plans. Have community networks. The people who suffer most are those completely dependent on fragile systems. The United States has $39 trillion in debt that is mathematically impossible to repay through conventional means. Debt grows at 8% annually, while the economy grows at 2%. Interest payments consume an ever larger share of the budget. Within 5 years, government will spend more on interest than on defense. Within 10 years, interest could consume 50% of all revenue. There's no political will to fix this. Neither party is serious about fiscal responsibility. They'll keep borrowing until the system breaks. The only question is whether it breaks through default, unlikely, through austerity, politically impossible, or through inflation, the guaranteed path. They will print money. They will inflate the debt away, and they will destroy the dollar's purchasing power and your savings along with it. This isn't prediction, this is mathematics. The debt spiral is already underway. The Fed has printed $5 trillion in 3 years. Inflation hit 9%. Your cost of living increased 20% since 2020. This is just the beginning. The real crisis arrives when debt crosses $50 trillion and interest payments hit $2.5 trillion annually. When the Fed is forced to print $3 trillion to $5 trillion yearly just to keep government funded. When inflation runs at 10%, 15%, 20%. When the dollar loses reserve status because nobody wants to hold a currency debasing at 15% annually. That timeline is 5 to 10 years away. You have a window right now to position, to move out of dollar-denominated paper assets, to own hard assets, productive assets, international assets, to eliminate bad debt and build skills. Most people won't act. They'll trust the system. They'll believe government will fix it. They'll hold cash and bonds and watch wealth evaporate. The 5% who understand what's coming will position accordingly. They'll preserve wealth through the crisis. Which group will you be in? If this analysis showed you the mathematical reality of America's debt crisis, subscribe immediately to The Econaut. The United States has $39 trillion in debt that can never be repaid. The printing presses are warming up and your wealth is the target. The math is clear. The timeline is 5 to 10 years. The only question is whether you see it coming in time to protect yourself.